Another week, another stocks rally at the start. Investors are feeling good. It's a shortened holiday week, so surely there's nothing to worry about. But maybe there is. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And admittedly, it is a slow week and not one with a ton on the economic calendar. It is also one where liquidity is likely to be thin because we have the U.S. markets shuttering for the Thanksgiving holiday. And of course, the U.S. markets are the most liquid and the largest, so that is likely to drain all kinds of participation and make for one of two things: either a slow and quiet drift, or in fact more volatility, because if something does in fact come out while U.S. markets are offline and participation levels are so low, that absence of liquidity is likely to see the price for all things jumping. And while U.S. markets are offline, we will still have markets open where they are over the counter, so currencies. We will have markets open where they are international and outside of the U.S. and are not on holiday. And so there will be plenty for Wall Street to chew on when they come back after the holiday, but also going into this period where we're going to have markets actually offline is anywhere between 2 to 3 days, give or take, depending on which thing you look at, of open trade, with all of this possibility for jumpiness baked in. And there is one important piece, at least, of fundamental, of macro event risk to keep in mind here. And that, of course, are minutes from the Federal Reserve's fateful November FOMC meeting. And so what we're going to do here is have a look at what that might give us here, what we might see from the Fed, whether they'll likely say something that surprises us or doesn't, and with that, to try to consider what the response from markets might be, even as we drift into this holiday lull. So, first and foremost, let's get a sense of where we are here. And this is a sort of catch-all we can see here from the way that things are shaping up. The dark line is the Office of Financial Research Financial Stress Index. That's from an arm of the U.S. Treasury Department. And we can see here it is back toward its lows for the year. We can see that in parallel with that, there's been a rise in stock markets. So the lighter line there, the S&P 500, approaching its highs for the year. So the mood in markets as we begin this week, admittedly positive. Now, what can these minutes from November's FOMC tell us to move this story? Let's consider that it begins really in September, in so much as November seems to be the end of a chapter in the Fed's post-COVID adventure here. The start of the chapter appears to have been the September FOMC. And so let's consider what we saw there. That was the last time that the Fed updated their summary of economic projections. They do this quarterly. They'll do it again in December next month. But note, here's what happens in September. The Fed says that they thought rates in 2024, that is next year, were going to average 4.6%. You can see there, that's the June projection. The September one is 50 basis points higher at 5.1. In other words, the Fed is telling markets that rates will be the equivalent of 2 rate hikes higher next year than the markets were benchmarking from the Fed's June projection. Needless to say, the markets do not like to see this. What happens in the interim is the markets say, wait a second, there's the September 20th FOMC here. You can see the reading is higher for longer. Needless to say, the Fed is not signaling that the rates here are going to necessarily mark 50 basis points in hikes, right? You can see here 2023 seen at 5.6. So the direction is one of easing, nevertheless, from 2023 to the following year, but to a less of an extent by a 50 basis point margin. So higher for longer is the message that the markets get. We notice here the front end of the yield curve, the 2-year yield in the green, that comes down, or at the very least starts to move sideways and tilting a bit lower, because again, no more rate hikes. But the extent to which the Fed is going to hold rates higher starts to feed significant uncertainty into the markets. They are surprised because the Fed is telling them it's going to be longer than they thought. And so the long end of the curve starts going up. Interestingly, what seems to be moving it higher, and the Fed has since acknowledged as much, isn't so much expectations for rates being higher in the future. It's quite the opposite. And we can see that in the green line, as a matter of fact, but it's the surge in term premium. What is this? This is the extra return that investors demand for lending over a longer period of time. It's a reflection of uncertainty. If I think that more could go wrong lending over longer periods than shorter periods, if I'm becoming less confident in my ability to forecast and to project what is going to occur in the long term, then I'm going to demand that I be paid more to lend over that longer term because I'm exposing myself to a greater risk of non-payment as a lender. And so that's what we see in the yellow bars going up. The market basically says, well, we don't know how much higher for longer is. We do know that the Fed is telling us it's 50 basis points higher. Who's to say for how much longer and when these cuts are going to actually start? What's curious, and we'll get to the touch point here for the November FOMC momentarily, which you can see marks an important reversal in this dynamic. But what then happens after this September 20th FOMC is the rhetoric out of the Fed actually starts going in a more dovish direction, as though what the Fed is intending to do in September is to signal to markets that they're offsides by 50 basis points, talk them into doing precisely what the Fed wants done, which is 50 basis points more in squeezing of borrowing costs higher, and then proceeds to tell the markets that they're probably not needing to hike rates further. And so you see here in this gauge of the hawkish versus dovish tone of Fed speeches outside of policy announcements here, September 20th marks a peak in hawkish rhetoric. So they release this summary of economic projections that spooks everyone and tells everyone the Fed is more hawkish than they thought, and then proceed to talk in the opposite direction, as though to smooth the adjustment. Now, what you then see here becomes very eye-catching. You move from essentially zero on the line here all the way up to essentially 50 basis points more. So you end up with exactly the increase in term premium in a positive direction that the Fed wanted to see in terms of its additional tightening. So then, understandably, you get this dovish rhetoric from the Fed that says, well, you've already made the adjustment. It becomes very emphatic when Jerome Powell effectively says as much at a speech mid-October with the Economic Club of New York. The economic backdrop, in the meantime, is complying. U.S. economic data isn't necessarily falling off a cliff, but it does stop to aggressively accelerate relative to forecasts, and you get a kind of stabilizing. Now, a good part of this is expectations for U.S. economic growth were revised higher around mid-August, which, as it happens, is right around where the data stops being able to beat those lofty expectations by as much of a margin. And so things start to cool off. But by no means does this speak to the U.S. economy falling off a cliff, at least not relative to expectations, and at least not yet. So from the market's perspective, they have a U.S. economy that isn't doing anything terribly worse than they expect, even as it sort of anchors. And the Fed is seemingly saying, we don't need to do more. November is where that narrative appears to get confirmation. And that's what makes November such an important touch point in this story. So, as promised, let's get back to this chart here. What we see is indeed that come November FOMC, the uncertainty here starts to shrink. So the term premium begins to be squeezed back down. Notice this is exactly the point where things top out and start going in the opposite direction. So the markets here are essentially saying, so the rhetoric the Fed has been setting up for us all through this move here is indeed what we thought. Rate hikes are over. The next move in rates will be down. When we look at the evolution of the yield curve over this same period, that is precisely what we see. Notice here is the current curve. This is in the solid line here. The dashed line is where we were with the Fed announcement. Notice we even tried a bit higher as of a week ago. But where we sit now is a meaningfully flatter curve, suggesting that indeed there has been a dovish shift in policy expectations in the wake of November's announcement, as though the markets heard what they wanted to hear, as though the Fed came out and said, right, you all think we're done, and chances are you're right. Now, the Fed, of course, is not saying this overtly. They're not explicitly signaling to markets, yes, we've finished. All of the relevant disclaimers continue about needing to beat inflation, watching, being data dependent, not pre-committing. Nevertheless, the markets in their actions and in the price action are signaling how they are reading what the Fed is saying. And in the shift in this yield curve, it's very clear that what they are envisioning is a less hawkish path than they did before November's FOMC. And again, what we see in the movements in the term premium and the 2 to 10 yield spread, which is what we just looked at right here, we can see that from September, the spread was widening. November marks the start of it narrowing. And so the markets are seeing less uncertainty, and they see that what the Fed wanted to achieve as far as tightening looks to have been achieved even in their own thinking. And so you get this kind of policy outlook. No further likelihood of a hike in December. More than negligible odds of something positive on rates occurring in January. A mere 2% chance of a hike, which looks more like a rounding error than anything significant. From there, rate cut expectations start to build. 32% chance of a cut in March, 71% chance of a cut by May. So that's a cumulative likelihood. So you can see 32% in March and 41, 42% in May. Take that collectively, and you get this right here. So about 71 in total. You start to look at June, and one hike is already baked in fully. So what you see here then is essentially a cut in May is likely, better than even odds at this point, 71%. But by June, it's already in the price with a further 26% chance right here that by June we actually get a second cut. That second cut is already fully priced in by September, though again, the markets are leaning with relative conviction, 78% that it happens earlier in July. By December, a third one is already in, and again, strong conviction it happens earlier in November, 97%. By December, three are there, and there's fairly strong conviction, 58%. So better than even, albeit narrowly, that there are four cuts, which is to say 100 basis points or 1 full percentage point cut from rates over the course of next year. At least 75 basis points in cuts, or 0.75%, are already in the outlook. And the response from markets is as one might expect. Here is how the S&P has performed. You can see these stories and these narratives evolve very clearly here. So here's the middle of the year. This is the peak in rate cut odds between December of this year, the last remaining meeting, and the end of next year. Over that period of time, so from the last meeting of this year through to the last meeting of next year, as of the middle of the year, the markets were looking for almost 2% in cuts. This is not surprising. This comes just on the heels of the SVB-led banking crisis. That's March. And then into April and May, there is the concern about the debt ceiling and the possibility that that's going to be some sort of a untoward fiscal headwind if the government is allowed to shut down. Both of those things, not surprisingly, give us a jump in rate cut expectations as the markets fear that the Fed is going to have to cut early to beat back a banking crisis if it starts to spiral and have contagion, and also to beat back a fiscal headwind if the government shuts down. It's not as though a U.S. default is a meaningfully serious conversation. It really isn't. But if the U.S. government were to shut down, even temporarily, it would stop spending. That absence of demand would hit GDP. It would hit growth. And so the markets here are at peak concern that the Fed is going to have to cut in a hurry to offset all these things. And then the banking crisis is mostly ring-fenced, at least so far. Meanwhile, the situation in Washington finds an 11th hour resolution, as it often does. And so these rate cuts start coming off the board. We can see that over this same period, fewer and fewer rate cuts are expected as markets normalize. The higher these bars go, so the fewer the cuts are expected, the more pain there is for stock markets, because, of course, it means that the cost of capital going forward is going to be higher. And so financing economic activity, that is earnings, is going to be more difficult. So stocks, understandably, come down. Once that move ends, and we can see where it ends, here is the end of September. This is where the Fed gives us that scary bit about needing 50 basis points more in tightening. We get one last leg down. Well, not surprisingly, come October going into November, this is where the Fed says, right, you've already done the heavy lifting. And stocks rebound. And this is where we get this potent surge that we are now watching here. A similar story is working in reverse in the US dollar. Here, what we're seeing is as you get fewer rate cuts on the board, the yield appeal of the US dollar relative to its major counterparts is improving. Because again, rates are seen as likely to be cut less and therefore to be higher and therefore to confer a greater yield advantage to owning dollars than other currencies because, of course, one person's cost of borrowing is another's income from lending. Which means that if you are an owner of dollars, the higher interest rates go, the more you could lend those dollars out for to generate a return. That's an income stream for owning dollars, much like dividends are an income stream for owning stocks, aside from the movement of the price of the asset itself. And so the dollar rises as its yield appeal increases. The story changes once the Fed bookends this September to October to November rhetorical device where they successfully talk markets into doing 50 basis points and tightening on their behalf, again, via the term premium increase. And as this starts to roll over, you can sort of clearly see with the naked eye here, the trend here is toward higher lows. That clearly has stopped as of here. So from September going into October and November, not surprisingly, the US dollar rolls over as stocks surge. And so the question then, of course, is, well, what are we going to get in these FOMC minutes since this is how the machine seems to work? Well, surely the Fed is not in the business of radically changing its position in between meetings. This is admittedly a massage document. It's not as though we are going to get a set of play-by-play verbatim statements as they were uttered in the FOMC meeting. We're going to get a summary. And the Fed knows that the summary is an opportunity to communicate with markets and to tell them something of a message that they want them to carry forward. And of course, November was that message. And we know how the markets have responded. So with that in mind, if this then is the baseline for what the markets thought of November's FOMC, less uncertainty, end of rate hikes, sooner arrival of rate cuts, so we can see by the green line starting to gently drift lower, suggesting that indeed easing is moving up in the timeline here. Well, then, minutes that are going to tell us more of the same might well be soothing for markets, in particular as they get ready to go off for the Thanksgiving holiday. And so the upshot of a more of the same, nothing particularly controversial set of FOMC minutes may well be just a green light for markets to keep doing what they've been doing, which is to say, to run up stocks, to push down the US dollar, because there is no particular reason then in the minutes to upset the narrative. Now, if the minutes were to present something untowardly hawkish that the markets jumped on, that, of course, would give us a push in the opposite direction, and with the liquidity, it might even be a sizable one. But the probability of that seems less likely than a statement that ultimately gives us something that jives with what the Fed has been saying, jives with what Fed officials have been talking about since the meeting and before it, and best case gives us a little bit more reason to be certain that rate hikes have ended and cuts are coming, or at the very least to change nothing. And if, like the last CPI report. We end up with something that's baseline status quo, maybe a shred in the market's favor with a tiny speck of additional support for the dovish narrative, then we might have quite the strong push into midweek, if only because the markets are relieved that nothing in this outcome upset a narrative that they're clearly happy with. And that is macro money for today. We have an abridged week this week, not surprisingly, so we'll be here Monday and Tuesday. We're usually here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, where we look at what happened on Wall Street and try to make sense of what comes next. This week, it'll be Monday and Tuesday, and then we'll be back for a full week thereafter. Typically as well, I'm also on with Chris for Futures Power Hour on Fridays. That's not happening this week, but we'll return the following week. And then on with Tom and Tony for First Call. That's Sundays. Writing for the News and Insight section of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Good luck trading out there. Happy Thanksgiving if you're celebrating. See you tomorrow. Take care.